Hey everybody, so I'm just going to do a quick introduction of everyone again. I'm Miyachi, this is John Jefferiers, he's the CMO of Cyphertrace, and this is Rod Garrat. He's a former VP of the Federal Reserve of New York and a technical advisor for the Bank of International Settlements. So let's start off with what is your relationship to digital currencies and what kind of work have you done in the space?
Sure. So, as I said, I'm John Jefferiers. I run financial analytics and marketing for Cyphertrace. We're a cryptocurrency analytics company or blockchain analytics. And what we do is we essentially augment the public blockchains, the various blockchains from Bitcoin to Ethereum to the Binance blockchain, and we engage in the cryptocurrency ecosystem to essentially create a yellow pages of the cryptocurrency businesses based on clustering technologies and machine learning. So we collect millions of pieces of attribution data every day through our interactions in the economy, and then run that through the machine learning clustering technologies to identify what's what. And based on that, we're able to follow the flow of funds. In the case of an exchange, we're able to help them determine whether or not the source of their funds is illegal. In the case of financial investigations, we're able to help trace lost and stolen cryptocurrencies and identify fraudulent use cases. We also help regulators very closely, so we work with the SEC as well as the countries of Bermuda and the country of Malta. So we help them essentially create a safe sandbox and understand the risk profiles of the cryptocurrency entities within their jurisdictions, which helps them get banked, because as most people are aware, one of the fundamental problems faced by cryptocurrency businesses is just opening a bank account. Because they're perceived as so risky. So we're able to provide a risk profile of those entities and help these auditors monitor them on an ongoing basis.
Yeah, Rob?
Hi. Yeah, so I was at the Federal Reserve Bank in New York back in 2013 when Bitcoin had its first price surge. And so this got the attention of the Federal Reserve. And so I led a working group that investigated, first of all, found out what Bitcoin was. That's essentially when I found out what it was. Basically this grew into a working group that was system-wide and included representation from every Federal Reserve Bank and the board, which was basically just a learning group and understanding what this technology was. And we would meet with a lot of people that would come in, a lot of early developers in this space, and just stay informed. After I left the Federal Reserve in 2015, I started working with the Bank of Canada on a proof of concept for a large value payment system that was built on distributed ledger technology. It was built originally on Ethereum, and then it was built on top of R3's quota platform. And the idea here was to introduce basically a central bank, basically I think the first stable coin. So this was a central bank digital currency that was traded on a digital platform used on a closed system for making wholesale payments among central banks. And then after that, I worked at the Bank for International Settlements as a technical advisor, where we wrote a report on central bank cryptocurrencies, and then most recently I worked on the G7 report on global stablecoins. It just came out last month.
Really interesting, guys. So the first question is for you, Rod. What is the value in stablecoins, specifically to centralized institutions?
Yeah, so I think stablecoins are really interesting because in a way, they're sort of antithetical to the whole idea of Bitcoin. Because Bitcoin is meant to be this decentralized technology, although I would say exchanges are antithetical to the whole idea of Bitcoin. Because Bitcoin was supposed to be an alternative currency that had its own system and didn't interact with conventional financial systems. So why are there Bitcoin exchanges? But the idea of stablecoin, flipping it not coming from the side of Bitcoin, but coming from the side of banking, banks look at this in a more practical way, I guess I would say. They're looking at technology and what are the possible uses of it, and so are the private banks. And one of the initiatives that's got a lot of attention recently are these ideas of stablecoins. And what stablecoins really do in principle is they give you a new way to transact the dollar. So typically a stablecoin will be a cryptocurrency of a type, and that is that it's a tokenized form of money that will trade on some type of distributed platform or blockchain platform, but instead of its value is tied in some way to a sovereign or a fiat currency. So one way that can be done is there can just be a one-to-one conversion promise. But promise is the key word there. So if you think about Tether, that's a promise. But we all, or many people know that there were some problems in terms of what Tether, in terms of whether or not the Tether that were issued were actually fully backed by dollars. Eventually, there was an issue with some funds that were sent to Panama that made that backing less than 100%. But in any event, the concept is that it can be backed by a dollar, or it could be backed by some algorithmic trading concept, or it could just be backed by the trust of the institution. If you think of something like JP Morgan coin, so JP Morgan introduced a tokenized form of stable coin, which was only available for its institutional clients, but it was a means for them to transfer deposits within a system using blockchain-style technology. So that was a stable coin, because that's linked one-to-one to deposits. But what are they backed by? Not formally backed by fiat currency, but backed by the institution, much like your deposits at a commercial bank are not formally backed by central bank money. That's a loan to the commercial bank. So there's a variety of forms of stable coin concepts, but in principle, this is I think a desirable idea. It allows you to transfer or transact dollars in a different way, and so that right off the bat, that gives you new possibilities. But then if you introduce the idea of smart contracts, programmable money, then there are future applications that we've not yet thought of that there could be advantage. And then the key really is doing this right. And so if you think about something like Libra, the new proposal by Facebook, this is a concept where that wasn't formally going to be backed by dollars, but rather there's going to be a fund that invested in multiple currencies and probably prime securities. And this would be more like an exchange-traded fund. You'd essentially be trading these Libra tokens, which would have value that was tied to a fund, but not an explicit redemption promise per se. So that could work, but then there's these trust issues. So a lot of people have trust issues with Facebook, and that came out in these congressional hearings. But again, the concept is in some sense a sound one, because again, it allows you to transact dollars or any currency in new and exciting, I guess, exciting ways. So then the real question becomes, again, who should do it? Should it be Facebook, or should it be the central banks themselves? So one of the things that came out, Mark Carney, who was formerly the governor of the Central Bank of Canada, and now is the governor of the Bank of England, talked about this in a recent speech, and he proposed something called a synthetic hegemonic currency. And so a great name, but what he was essentially saying is, I think the idea of stable coins is a good idea, but maybe they should be done by the central banks. And so this is yet another concept that's been floating around. So again, I think from the point of view of Bitcoin purists, the whole idea of a stable coin is kind of not where we should be. But if you think of it from the point of view of central banks and commercial banks, they're not looking at it from an ideological way. They're looking at it from a practical way, and they're thinking, what part of these technologies can we use to make our operations better? And in that sense, I think stable coins are in the future. What form exactly they come in, I'm not so sure, but we can talk more about it. But stablecoin, when the Libra announcement came out, that got a lot of attention. One of the reasons why that got a lot of attention, first of all, was that it's Facebook. And so, we're talking about something that could have massive adoption. Bitcoin, as interesting as it is, it's inconsequential at its present formation, it's inconsequential from a central bank monetary policy perspective. It's just too small. 7 transactions a second, or maybe 14 transactions a second with SegWit, or whatever number you want to use. Visa does 20,000 a second, Alipay does 100,000 a second, so it's absolutely inconsequential in its current form. But Libra, on the other hand, could be massive out of the gate. And then secondly, the other thing about Libra, which I didn't really get into in my brief description of stablecoins, is that Libra wasn't denominated in a single currency. Actually, I did mention this. Libra was denominated in terms of a basket of currencies, which means that it's its own unit of account, which means that it would actually have significant monetary policy implications for a lot of countries, especially small developing countries, if it was adopted. So the Libra proposal is a big deal. They're instantly passing. There were two bills just recently put forth that we're looking at regulating and legislating Libra. There'll be more to come, but the concept of Libra is a big deal.
No, really interesting. John, according with you and stablecoins, you track a wide variety of digital currencies. Do you notice any specific trends that are specific to stablecoins themselves?
Not really. I think, one of the things that stablecoins brings to the table is it really, there's multiple promises of Bitcoin. Obviously the decentralized nature, but, you hear people like Andreas speak about internet money, and, given both the volatility and the appreciation of Bitcoin, it doesn't really work for most of us for internet money. You might want to carry 20 or $100 on your local wallet, but if you're actually going to do day-to-day transactions, no one wants to be the guy who paid $25 million for a pizza. So I think what stablecoins do is they provide us an avenue to enjoy a lot of the benefits of crypto without necessarily having the financial exposure of a volatile underlying instrument. To the doctor's point, I think you're a doctor? Yes. I got that right, good. Still a doctor. I think there's really three types of stable coins. I think of the asset-backed ones, and I divide those up between those that are cash-backed and backed by other real assets. And there's a real hard line between those that are insured, like the ones like Gemini that are under the New York Attorney General license, the so-called BIT license, they're typically insured by an FDIC equivalent type of insurance. They're audited. They have disaster recovery programs, security programs, CISOs, and so those are relatively stable. As the good doctor mentioned, the Tether has been an interesting element because they have promised they had one-to-one backing up until the day that they lent their sister company $625 million, in which time they effectively changed the terms and conditions of their underlying instrument, which I don't think the U.S. government can do with respect to dollar, but they instantly did. So I think when you're looking at these coins, you need to look at the underlying instruments, and then obviously some are backed by crypto themselves, which is highly volatile, and then some are backed by algorithms such as Basis, which may end up being backed by a securities and may incur some of the wrath of the SEC.
Yeah. So one thing not mentioned is Dr. Garrat is also a chair professor here at UCSB, and he actually conducts research in the crypto space. So you touched on Libra a little bit, but I know that your G7 paper talked about it a little bit. So what caused all the stir where there's 2 congressional hearings off of just an announcement, and what were some of the conclusions behind your research in the G7 paper that you found out about Libra?
Yeah, so first of all, let me clarify that this is work that I did when I was recently this summer at the Bank for International Settlements, and these are reports this report was put out by the G7 with participants from central banks from the G7 countries, the treasuries of those countries, and the Bank for International Settlements itself, and there are dozens of contributors to this report, so it's not my paper. I was just one of many contributors. But I think what that report really said, which I think should be interesting to the community, is that first of all, this report acknowledged that there are 2 big problems with conventional payment systems. One was the accessibility issue. That is, not everybody has access to payment systems. And then the other was this issue with cross-border payments, that it's just very expensive, and to make cross-border payments, that it sometimes takes too much time. And so they recognized there was a need for improvements in both of these areas, and they recognized the possibility that stable coins could play a role in alleviating both of these problems. So I think that's the first point. But then it moved into talking a lot about the legal issues that we can maybe talk more about, and the regulatory issues. And the tone there is maybe a little harder in the sense that while it acknowledges that international regulations are lacking and that there's a need to coordinate on international regulation, and a lot of international communities are doing this, both in terms of the regulation side and in terms of the law enforcement side, so the financial action task. course, PADF, is an international committee that's looking at things like anti-money laundering, anti-terrorism financing, and so on. And so we need regulations on that side, but also just regulations in terms of how these entities would work and how they would be supervised. So they recognize there's a need for improvements along those lines, and this is a fast-moving space, so I think we have to cut the regulators a little slack on this. But they also say that people can't act until there's regulatory clarity, so people need to know the rules and comply with the rules before they act. One of the sayings that I've heard at conferences in the last few years is that this isn't Uber. So it's not about having a taxi cab or running a car that's like a taxi cab in an area that's licensed for taxis and getting a wrist slap. That if you move money internationally illegally, this is jail time. So people have to be very careful in this space. And so I think part of that was just letting people know that people need to comply with the rules, because this is serious stuff when it comes to international movements of money.
Yeah, I definitely think it's one of the most interesting and confusing topics, some of these legal rules behind cryptocurrency exchanges and the movement of cryptocurrency. So can we touch on the FinCEN just had a recent guidance discussing actually the travel rule coming out and their stance that they're taking on transacting cryptocurrencies?
Sure. So I'll back up a step and say that there is actually two travel rules. So there's the so-called FATF travel rule, which is guidance that was issued in June of this year, which gave the G20 countries, 37 of them, 12 months to implement law and put it into force. And that law essentially says that when an exchange moves money over $1,000 between another exchange, that the sender and the recipient information needs to precede that, or the transaction cannot take place. That is not part of any blockchain that any of us know, and it's not part of any infrastructure that most cryptocurrency exchanges have today. So the industry was in a state of denial. The FATF gave that guidance in January of this year, and no one believed they would follow through. They did follow through, but even more pressing for a lot of U.S. companies is on Thursday of last week, FinCEN came out and said that we had told you so. They said we told you so in May, we told you so in 2013, and we told you so in 2011, and we are actively taking action against exchanges that do not comply. So they said they mean it, and they also highlighted the fact that the travel rule was the most cited citation that they take against cryptocurrency businesses, which is not the perception that most exchanges have today. So it's a big eye-opening event. It is something that may cause the end of many entities if they don't comply. As the doctor said, they don't tolerate non-compliance, and they don't feel the need to give people the opportunity to fix it or give them warning to fix it. They believe they've given adequate warning and that this law is in place today. So it is significant, and we should expect action. We saw an example of this applies what they call to VAS, which is Virtual Asset Service Provider, which includes kiosks as well, so Bitcoin ATMs. And there's a recent instance where an operator of a Bitcoin ATM was in flagrant violation of the anti-money laundering laws, and he now faces up to life in prison. So the ramifications of non-compliance are well beyond a slap on the wrist.
Yeah, no, they're definitely coming down hard and enforcing it pretty strictly. So for an exchange or someone, doing high volumes of cryptocurrency transactions, is there any mechanisms to either protect you as the consumer or any exchanges that you guys recommend in terms of platforms abiding by proper KYC AML laws?
So I think, one of the things that's happening right now is in highly regulated environments, things are much safer, right? So I've done analysis that compares level of direct criminality of Bitcoin within ATM or within exchanges within highly regulated environments, which I found was 0.25% versus in unregulated parts of the world where it was 39 times higher. So that means that on multiple dimensions that what's going on in those offshore exchanges is risky. It could be gambling, it could be ransomware, it could be fentanyl, and easily terrorist financing. So I think there's a sense that the regulatory curtain is being drawn, and so in the next 9 months, most of the world will be safe, and we'll start to see kind of the haves and the have-nots, where there'll be countries that are not part of the G20, and you'll start to see what they call regulatory arbitrage, where people are trying to move their money, especially if it's dirty money, to those exchanges.
Okay, interesting, yeah. Yes, yeah. This one's for Rod. So you've done work with central banks, and you touched on the JP Morgan Chase coin. Can you walk through some of your perceived pros and cons between centralized coins versus commercial bank coins, and some of the benefits of each?
That's actually a really good question. So one of the, not that all the questions weren't really good, but I'm surprised you asked that, because it's a subtle question. So there's something called principles for financial market infrastructures. And so many people that are dealing in this space ultimately would be financial market infrastructures. And so there are these rules that any type of entity has to abide by. And one of the main recommendations is settlement in central bank money whenever possible. So that's what all the payment systems globally aspire to. Settlement in central bank money whenever possible. And so all of the payments that you do, which go through banks, these ultimately settle through large value payment systems, which are settling in central bank money. And so when it comes to thinking about stablecoin initiatives, this is one thing that these new projects aspire to. So maybe some people have heard of something called utility settlement coin. So utility settlement coin is a consortium of private banks that are looking to get around part of the difficulties with cross-border payments by forming their own, essentially, group, building a distributed ledger platform, and they'll move money internationally between participant banks. And the issue is then, well, what are you actually moving when you do that? So you're moving a token on a distributed ledger, but a token on a distributed ledger isn't money. It's an electronic token. And so what typically these concepts want to do, and as I mentioned earlier, this goes back to the Bank of Canada's original proposal. We call those digital depository receipts. So what these tokens actually represent is they're a claim on money held elsewhere. So I send you a digital token. So a Bitcoin token is something the token is itself. That is what it is, and there's value inherent in the fact that people believe in it and are willing to transact in it. But these tokens get value because they're linked to something. That is, the token that is issued on top of the ledger, and Ripple is similar to this, by the way, if you've heard of that concept. The value that this token is linked to is what is that value? Well, one thing that value could be is it could be money at a commercial bank. But if it's money at a commercial bank, then that's commercial bank money. That's a subtle distinction, but again, I go back to this idea that the money you have at your Bank of America account, those are not US dollars. Those are Bank of America dollars. Your claim is on the Bank of America, not on the US government. Okay? You can go to the bank and you can say, hey, I'd like to transfer my Bank of America claim into US dollars. Will you do that for me? And they will. But you got to hope they do. And we have deposit insurance, and we have lots of reasons why you should feel totally fine with that. Don't get me wrong. But those are claims on the Bank of America. And so to get closer to the principles for financial market infrastructures, what you would really like to do in these new distributed ledger concepts is you'd like the central banks to be holding that money. You'd like the tokens that you're trading on those distributed ledger platforms to be claims on actual central bank money. So if you can get the central banks involved in those problems, then that in some sense is an advantage. That gets closer to what you want to achieve in terms of these principles. And also it removes an important ingredient from the whole equation, which is credit risk. That is, that if I'm taking tokens and I'm trading them on a ledger, and especially remember that for this systems to work, I pay you a token and you need to use that token to pay someone else, and you want that token to be able to move all over the ledger to facilitate lots of transactions. The end user doesn't necessarily know the issuer, but they have to trust that the value underlying that token is good. And if it's issued by a commercial bank, then you've got to trust that that commercial bank is solvent. And again, most banks that's not really a big risk, but it's not as good as if the tokens backing or the value backing the tokens is central bank money. So that's something that they aspire to.
Interesting, yeah. So, talking about trust, with these centralized banks, like you're establishing trust that, those Bank of America dollars are going to be able to cash it out as US dollars. So in terms of Libra, we're essentially trusting, whatever, these 27 tech companies we're going to be able to cash out to US dollars. Do you see that as being because it's 27 different tech companies, as more of a stable trust platform than what we kind of have right now with centralized banks?
Well, again, I think with Libra's a little bit of a different animal because of the fact that it wasn't going to be denominated in a single currency. So then in a way, it becomes more of a competing currency, say with the US dollar, then it becomes an alternative way to transact US dollars. So Libra is a different animal in that sense. But going back to the idea of trust, Libra, would have the Libra Foundation. They would manage a portfolio, and you would, in some sense, have a claim on that portfolio. And I should mention that in most applications, you're not just trusting blindly. So, what we hope to get to is a point where the institutions that do these things are regulated and supervised, and that you get some trust coming from those aspects. One of the problems with Tether is that it's not regulated and supervised to the extent that it needs to be. In fact, recently the New York Attorney General filed a suit against Tether. And so, we all want to get to a place where, to the extent that these things are beneficial, and I think I've made a case that I do believe stable coins are useful. We want to get to a place where whether they're issued through private institutions or they're issued through central bank initiatives or whether they're issued through cooperation between central banks and private sector initiatives, that they function smoothly because they have a vast potential for economic and social benefits.
Yes. So when I was watching the Libra hearings, one of the points that Mark Zuckerberg brought up was that specifically China was working on these types of currencies that, if the U.S. doesn't implement something similar, China, if not another country, will try to implement that. So this one is for both of you. In your tracking, do you see a lot of foreign activity or anything specific to China or any other specific country? And then what do you think about, you've worked internationally in Canada and in the US. Do you see any differences between the different countries' implementations of a centralized currency?
I would say that we're definitely seeing in the last 12 months or so an increased geopolitical activity around cryptocurrencies, starting with Venezuela with the ill-gotten petro, but they're still going for it. They just announced that they're going to force retirees in Venezuela to accept it as their pensions. But more importantly, what we're seeing is countries like Iran and North Korea and Russia really using different forms of cryptocurrencies and different cryptocurrency strategies to undermine the US dollar. And I think at the end of the day, that's probably what has the US regulators most concerned, because while our armed forces are very powerful, they pale in comparison to the US dollar. And I think it's the undermining of the US dollar that we're starting to see these various institutions or various countries trying to do. One of the brigadier generals of Iran came out in the last 12 months and said, they're not even worried about sanctions because they can move all the money they want around with crypto. Iran has, very cheap oil, so it's a great place to mine. They just legalized crypto, and then, the Russians are very, very aggressive and have a lot of really interesting research projects, including quantum protection for smart contracts, which makes you wonder why the Russians would be wanting to protect their contracts so tightly. So there's a lot of geopolitical activity, and I firmly believe that it's just a matter of time before major governments are releasing their own fiat or their own crypto fiat.
Quickly, can you touch on a little bit what exactly they're doing to undermine the US dollar and what mechanisms they're using to do that?
Sure. So they're basically undermining the effectiveness of sanctions, right? So we say, whether or not your feelings are about Iran and whether or not they're actually building nukes or whether or not we should be sanctioning them, that is a power that we try to exercise as a country. And by having different people accept that, they are effectively undermining it. So the Russians and the Iranians are coming up with an alternative to SWIFT, which the doctor could explain better than I could, but it is the mechanism that we use to control international transfers of funds. By coming up with their own mechanism, by, the Chinese yuan, which they're trying to release, that soon will probably be the only or the primary currency accepted within ports that the Chinese choose to dock in. So they're effectively making the US dollar less powerful and making other cryptocurrencies alternatives.
Thank you for that. Yeah, I appreciate it. And then Rod.
Yeah, I think I'll just touch on a slightly different aspect, which is that most of the comments I've made have certainly been from the perspective of developed countries, because those are just the places that I've worked on projects. But this, the role for stablecoins, the role for central bank digital currencies or cryptocurrencies in general are quite different across different countries. So, for example, in Cambodia, they've done a lot of work with blockchain technology and looking at potentials for central bank digital currency that could be transacted on distributed ledger platform. And part of the reason for this is that I heard a representative from their central bank at a speak recently, and they said they don't consider blockchain technology to be disruptive. And people were, well, why is that? And she said, well, because there's nothing to disrupt. So in places where you don't have these entrenched existing and I should say well functioning. I mean, you don't have any trouble paying for things in this country. Currencies. There's less of an incentive to try these new technologies as solutions. But in places where there's a much bigger problem with unbanked and things like that, these solutions are emerging. But I should mention there that these aren't always blockchain-based solutions. So one of the things that when I started investigating Bitcoin back in 2013 for the Fed, one of the things I quickly learned about was something called M-Pesa, which is widely used in Africa and India, which is not blockchain-based. And transaction volumes there dwarf Bitcoin transaction volumes. It's absolutely massive by comparison. And that is basically mobile phone money, which is based on central accounts. It was done ultimately done in cooperation. It was started by Vodafone and Safaricom, but ultimately done in cooperation with central banks, and has been a very effective way of allowing unbanked people to transact electronically. And so there are solutions out there, and sometimes blockchain type solutions are the best, sometimes they're not. But certainly the question of when is this technology appropriate, when are central banks thinking of introducing central bank digital currencies, it varies greatly depending on what the country is and what the need is.
Yeah, no, both really insightful in terms of your different experience with that. So I was just given, we have 5 minutes left. Does anyone in the crowd have any questions for the panelists?
Yeah, so this is a question for Rod. So I'm personally skeptical of algorithmic solutions for stablecoins. I'm a little skeptical of Libra's solution of sovereign currencies and bank deposits because it potentially creates a race to the bottom and a search for yield. Do you have a favorite backing asset, either financial or hard asset backing for stablecoins?
Yeah, so that's a good question, because there's been a lot of things that have been floated out there. So this idea, this basis stablecoin, which was going to be, the idea there was that they were going to hold a portfolio of bonds and currency, and they were going to have something like a Taylor rule, which is just a function for managing money supply, to maintain stable value. And they ended up disbanding and giving back the money that they had left. Because they realized that they were going to have to be regulated as securities for the bond portfolio from the SEC. I think whether or not any of these concepts would work, it's hard to say. But my favorite, I guess, is just the idea that it's back one-to-one to a single currency. Because as I said, I'm looking at a very simple use case, which is just expanding the platforms on which you can trade the domestic currency. And ultimately down the road, the potential to trade this currency in more innovative ways. And so then again, I'm thinking of this idea of programmable money, or the idea of using currency on platforms that can implement smart contracts. So I think the simplest concept is at least the best for starters. But we'll see. We'll see which ones takes off. As I mentioned, Libra is complicated because it's not just an alternative way to trade a sovereign currency. It's its own currency. The fact that it's multi-denominated, that what backs it is a basket of assets, means that it becomes its own unit of account and would be a competing currency with the US dollar. Now, would it get so big that it would undermine the US dollar's role as a reserve currency? Who knows? Would a vast majority or a significant fraction of transactions in the US be in terms of Libra? Who knows? But for small developing countries, you could easily see the case, or countries that are having financial turmoil, Venezuela, you could easily see the idea that it could become very prominent very quick. But that's not something that's in the control of a single country.
The question for Rod. So we have the European Union, I think, read a couple of days ago that is announcing 400 million to do something with a token or something. So how likely it is, or is there any conversation within all the countries, meaning all the European countries, the American country, creating something similar to the euro? How, countries got rid of their currency, adopted the euro, so that would compete, for example, with the Chinese yuan versus, Libra or American dollar and digital euro.
Yeah, so as I mentioned, there's really this idea is starting to circulate. So as I mentioned, Mark Carney introduced this idea of the synthetic hegemonic currency, which was again the idea of central banks, producing their own idea of a stable coin. And then also the IMF recently released a report where they introduced this notion of a synthetic central bank digital currency. And the idea here was actually to support private sector initiatives to produce stable coins. So instead of the central bank introducing the stable coin itself, the central bank basically helps secure the funds that underlie the tokens, but helps facilitate this idea. So I think, like I said, I think a lot of people can see the value in these types of initiatives, stablecoin initiatives in particular, and I think the central banks are thinking about either doing it themselves or doing it in cooperation with private sector banks, and this is happening around the world. I mean, China will very likely be the first major country to introduce central bank digital currency. That's likely to happen in the next few months.
All right. Well, one more question. Yes.
Thank you for your great panel discussion up here. Thank you so much for letting us know your knowledge. I had a question about the digital currencies. I think you said that iTokens in the case of the world reserve, U.S. currency, and you said that it would bring us closer to accountability. As we know, there's quantitative easing, right? So how does that solve, or how does that bring us closer to accountability of them, the Feds, central banks, just printing out more digital currencies?
Yeah, so that's, I could talk on it for an hour on that one. That's a great question, but in limited time. Strictly speaking, the fact that you change the form in which dollars can be transacted doesn't really affect how many dollars the United States decides to create. Mm-hmm. So that's a basic monetary policy issue. There is work that suggests that monetary policy could be more effective with central bank digital currency, because then you're basically allowing if that happens, then once you have a central bank digital currency, then suddenly you're allowed to bank with the central bank. And so there's a much more direct link between the public and the central bank. Now that is actually not consistent with the Bank Act. So that would have to be changed in the Bank Act and government approval for that sort of thing to happen. But strictly speaking, it doesn't really say anything about sort of basic monetary policy decisions regarding money supply.
I think there still remains, with respect to the digital yuan, I think, we've all, at least most of us, have experienced some of the technical issues of just day-to-day operations and scalability of Bitcoin. So, while there's this posturing by these various different government entities, the practical implementation is not 2 months away. I think, the practical implementation of it is much farther, but I think that the U.S. is going to have to take a much more aggressive stance just for defense.
Great. So that's all the time we have. Thank you so much for our panelists, and